Have you ever looked at your trading statement, your P&L, and thought, wow, this looks less like a nice climb and more like, well, like a heart monitor, those big spikes up, then these crushing drops
Oh,
down.
yeah, that feeling.
Exactly. One minute you feel like you've cracked it, you've got the Midas touch, right? And then poof, the game's vanished. Maybe over trading, maybe getting, I don't know, emotionally stuck on a stock that's just not working.
It's a very familiar story for a lot of people getting into the markets, that emotional roller coaster.
Well, today we're doing a deep dive into a really fascinating story that tackles exactly that challenge. We're looking at insights from a review covering Nicholas Darvis's classic book, How I Made $2 Million in the Stock Market. It's originally from 1960, but the principles are still incredibly relevant.
Absolutely. A real classic.
And our mission here is to unhack his journey. I mean, this guy went from being, frankly, an amateur making all his common mistakes to this incredibly disciplined trader. He turned, get this, $10,000 into $2 million
In 18.
in just 18 months. So we're going to pull out the key ideas from his famous box theory, look at his principles, and really understand how having a solid process can sometimes be way more important than trying to predict what the market's going to do next.
Process over prediction. That's a great way to put it.
Okay, so let's unpack this. Nicholas Darvis, written back in 1960. Who was this guy? And, why should we really pay attention today with markets moving so fast?
Well, what's so interesting about Darvis is he was about as far from a Wall Street guy as you could imagine. He wasn't a fund manager, not an analyst, didn't have some fancy finance degree.
Okay, so what was he?
He was a professional ballroom dancer. He toured the world performing, night after night, and he was trading stocks from hotel rooms using telegrams. Can you imagine?
Telegrams. Wow.
Yeah. So his results weren't coming from like analyst reports or secret inside tips. It was all based on him just studying price and volume action. He built a system that fit his, well, unique lifestyle.
That's incredible. So what makes his story still compelling then, besides the dancing, I mean?
It's the transparency, his track record. He didn't just tell the story. The book lays out exact trades, entry prices, and stop-loss placements, turning $10,000 into over $2 million in 18 months, all documented.
Wow.
That makes his framework, really relevant for anyone working outside the institutional machine. It proves you don't necessarily need all the fancy tools, but you do need a process and, critically, discipline.
Right, discipline. It sounds like he just hit on this magic formula right away, but the book actually talks about his messy start, doesn't it? Going from an impulsive speculator to something more disciplined. What were some of those early mistakes?
Oh, he was, as the review says, brutally honest about his failures. And that's part of why the book works so well. His early Canadian period, for example, he was just blindly chasing these penny mining stocks based on barroom tips.
Uh-oh. Been there.
Exactly. Predictably, lots of frustration, lots of losses. Then later, trading on Wall Street, he had what he called my first crisis. A really bad bet on a stock, Jones & Laughlin. Over-leveraged, refused to sell.
Ah, the anchoring bias. Holding on and hoping.
Precisely. Classic anchoring bias. He just kept hoping it would turn around, maybe even added more money and just watched it sink. He learned the hard way that, well, hope isn't a viable trading strategy.
Okay, but here's where it gets really interesting, right? He didn't just make mistakes. He learned from them. How did he actually turn that pain, those losses, into a workable system? Was it just willpower?
It was more than willpower. He
Wow.
fundamentally changed how he looked at it. He used every loss as data, every failure as feedback. That wasn't just a slogan for him. It was his operating principle.
So analyzing the mistakes?
Deeply. He channeled all that frustration from the early screw-ups into building a process designed specifically to take his own emotions, his own biases out of the equation. He figured out he was his own worst enemy sometimes.
Makes sense.
And this rigorous self-analysis, looking hard at why he failed, led directly to his box theory. It was basically a way to spot patterns of price containment and breakout behavior. Looking for that consolidation, then the decisive move.
Okay, so the box theory, let's get into that. What is it exactly? How did a dancer figure this out and trade it remotely?
Right. So the box theory, it's essentially a disciplined, momentum-driven, trend-following system. Pretty logical, actually. Darvis would watch a stock, and if it started trading in a narrow range, say between $50 and $55 for a period of time, he'd draw a mental box around that range.
Okay, the consolidation phase.
Exactly. He wouldn't do anything while it was in the box. His rule was to buy only when the stock broke out above the top of that box. And crucially, this is important, with volume confirmation.
Volume confirmation, meaning?
Meaning a big jump in the number of shares traded as it broke out. That signaled to him real conviction, maybe institutional buying, not just some random wiggle. The market had to prove strength first, as he put it. He waited for validation.
So he wasn't trying to guess the bottom or buy early. He waited for proof.
Exactly. Wait for the proof, then jump on board. And this approach naturally helped manage risk because you're buying strength that's already demonstrated itself.
Did he stick purely to that?
Yeah,
Or did it evolve?
it did evolve. Later on, he started combining these technical breakout setups with looking for earnings acceleration. So finding companies whose profits were growing faster and faster.
Ah, adding a bit of fundamentals.
Yeah, kind of a fundamental overlay on the momentum. It showed he could adapt even when he felt the market was getting trickier, like in what he called a baby bear market.
Okay, so bringing this back to us, to you listening, what are the real actionable rules or lessons that came out of this? Things you could actually apply?
Yeah, definitely. His journey gives us some really clear, potent takeaways. First, only buy confirmed breakouts. Don't anticipate. Wait for the market to show you the strength. Let the stock break out of that box with volume. It reduces guessing.
Less predicting, more reacting.
Exactly. Second, use stop losses. Always. Darva said he never held a loser. Every trade had a preset exit point if it went against him. This kept any single loss survivable. Non-negotiable risk management.
Absolutely crucial. What else?
Third, let winners run via trailing stops. Instead of grabbing small profits, he'd move his stop loss up behind the rising price. He'd trail it. This let him ride the big trends. His quote was great. I just jog along with the trend, trailing my stop loss insurance behind me.
Jog along with the trend. I like that. Protects profits but gives them room.
Right. And fourth, maybe the hardest one. Detach emotionally from stocks. He didn't care about the company's story, the news headlines. If the price action told him it was time to sell, he sold. No attachment.
There are no good or bad stocks. There are only rising and falling stocks. That's his famous quote, isn't it?
That's the one. It forces you to respect the trend, not your own opinion or hopes. It's about clarity over emotion.
That emotional detachment, it sounds key, but also incredibly hard to achieve. It feels like his whole system was designed to force that structure, that discipline. How did that process lead to the big success? And how does it help us avoid common mistakes today?
Well, the book tracks his journey, from making his first $500,000, then facing a second crisis. This time, interestingly, born from overconfidence after success.
Ah, success can be dangerous too.
Very dangerous. But he learned from that too, eventually reaching the $2 million through, again, refining his process. Controlled entries, tighter stops, larger wins. It really underscores how understanding his own psychology, his own weak spots, was just as important as understanding the market. He built the system to protect himself from himself.
So self-knowledge was critical. But look, the book's from 1960. Markets today are, vastly different, right? High-frequency trading, algorithms, global news hitting instantly. Are these lessons, is this box theory still truly relevant, or is it just a nice historical anecdote?
No, I'd argue they're absolutely relevant. The core principles, understanding price action, following trends, disciplined risk management with stop losses, these things are timeless.
Because human psychology doesn't change that much.
Exactly. The market's plumbing might be different, master, sure. But the underlying forces of fear and greed, supply and demand, expressed through price and volume, that's constant. Darvis's method, focusing on that behavior, still works, especially as the review notes, for swing and momentum traders.
So maybe not for long-term value investors or quants.
Probably not their primary tool, no. It's not for quants or value purists. But if you're someone who believes you can gain an edge by following market behavior, rather than trying to predict earnings years out, then yes, it's incredibly valuable.
And how does it help with those common mistakes we mentioned?
Directly. It stops you from chasing tips or news headlines like Darvis did early on. It prevents holding losers hoping they come back. Remember his Jones and Hoffman disaster? The stop loss fixes that. And it fights overtrading for action, not edge, because you have clear criteria for entering, not just jumping in because you're bored.
Right. It imposes patience.
It does. And interestingly, he sort of became an insider without actually being one. There's a story about him buying M&M stock just based on the price action. A huge breakout with massive volume. Turned out there was an unknown merger bid. He didn't know the news.
But the chart knew.
The chart knew. The price action was the inside information, in a way. It validated just watching the tape.
So wrapping this up, what does this all mean for you, the listener? Nicholas Darvis's story, it's not just some dusty old tale. It feels more like a practical manual, doesn't it?
I think so.
It's a really powerful reminder that, maybe trading success isn't always about being the smartest person in the room or having the most complex data or needing those insider connections.
Absolutely. It's about that transformation he made from chaos to consistency.
Yeah.
And that wasn't luck. It was building a framework. Strict rules, sticking to them, understanding price behavior, taking the emotion out. The box theory, really, it's just a decision filter, isn't it?
A decision filter. Explain that.
You wait for the signal of the breakout, you manage your risk immediately, the stop loss, and then you manage the winner, the trailing stop. Wait. Manage risk, let winners run. Simple, powerful.
Darvis really proved that edge in the market. It might not be about IQ or having more information than the next person. It seems like it's much more about behavior, your own behavior.
That's the core lesson, I think.
So here's something to think about. How might your own trading results change if you shifted your focus? Shifted away from trying so hard to predict the future and instead focused intensely on just managing your own actions, your own emotional responses. What could you achieve if you genuinely started treating every loss not as a failure, but just as data, as feedback to build a better process?